Realty Income Corporation is seeing a huge sell-off. In the past month alone, they're now down over 6%, and in the past 5 days, down 3%. And to put this into context, this isn't happening to the whole market. In fact, the S&P 500 just had their best week of the entire year. There was green pretty much everywhere. So what's the reason for this sell-off with Realty Income? And there's a few different things we have to take into consideration. Now, first off, the company did just release their latest quarter's earnings, and they saw mixed results. They beat on top lines, but they missed on bottom lines. Now, what's interesting is if we look at the chart for Realty Income over the past year, they're up around 12%, and year to date, they're actually pretty flat. And we can see they started to see huge gains here during the beginning of July. So what happened here? Well, this is when there began to be a lot of speculation that the Federal Reserve was planning on cutting interest rates. And obviously, that's very bullish news for REITs and companies with high starting dividend yields, because it means high yield savings accounts are going down, risk-free returns are going down, making these high yielding companies a lot more attractive. I mean, Realty Income has a very nice starting dividend yield sitting about 5.61%. But part of the reason this most recent sell-off is so interesting is the Fed actually just cut rates again. They cut them by a quarter point just the other day. And actually, if we look at projections, the Fed is planning on meeting again in another 35 to 40 days, and expectations are that they're going to cut rates again. And in fact, if we look at expected rates over the next few years, we can see 2024, 4.4, 2025, 3.4, and by 2026, all the way down to 2.9. So with interest rates declining and expectations of them continuing to decline, most people would think you'd start to see this stock rise even more, but that just wasn't the case for Realty Income. So we're gonna have to dig into this a little bit more. So I wanna start by looking at the company's overview and digging into that earnings presentation just a little bit more. Now to start off, you have to understand Realty Income is a very popular REIT because they've seen phenomenal returns since their inception. Since their inception, the S&P 500 total shareholder return is over 2,000%, and with Realty Income, it's over 5,000%. That's a pretty massive difference. And also keep in mind, like we already pointed out, the company has a very high starting dividend yield, and this company actually pays dividends on a monthly basis. So you get dividends every single month. And not only that, but they increase those dividend payouts on a quarterly basis. This company is a dividend aristocrat, meaning they've increased dividends for over 25 consecutive years. It's pretty rare that you have a REIT that can increase dividends for that long of a time period. So think of all the different time periods they were able to survive. 2020, for example, a lot of REITs had to cut dividends, but that just wasn't the case for Realty Income, and in fact, they increased their dividends during that time period. So it's easy to see why people get excited about this REIT. If we come down to the 7th slide, let's understand their lease structure a little bit. Most of their tenants operate under a triple net lease. Now, what does this mean? Well, the client is responsible for certain property expenses, examples, property tax, insurance, maintenance, and utilities in addition to rent. And this gives Realty Income nearly 100% gross margin, so this is a big deal. And not only does it help with the gross margins, but it also makes the income that Realty Income is going to be receiving very predictable and very stable. It's not going to fluctuate due to these other expenses. And then if we come down to this 11th slide, we're going to see the term total operational return. Now, what does this mean? And this is a term Realty Income actually throws around quite a bit. Well, basically what we're going to do is we're going to add the historical average dividend yield, sitting at about 6%. It's a little bit lower than that right now at about 5.5 or 5.6%, but then the historical average AFFO per share CAGR, sitting at about 5%. And this is telling us when you add them together, the average total operational return is 11%. What does this mean? Well, this is giving us an idea of what type of return we should expect. Keep in mind, if we average a 6% dividend yield, obviously as shareholders, we're getting at least a 6% return. But we have to remember, AFFO, that's essentially earnings per share for REITs. Over the long term, stocks and REITs are driven by their underlying fundamental growth in AFFO or earnings per share. So they're arguing that if AFFO is growing at 5% on average every single year, the share price will follow. So yes, Realty Income has historically driven very good returns for shareholders, but one of the things you always have to take into consideration when looking at any stock is what is the return you're getting in comparison to the risk that you're taking on. For example, if you told me I could buy a stock and there's a 60% chance that I could get a 13% return, that sounds pretty good. But if the 40% chance is that it goes to zero, all of a sudden that's not a stock I want to add to my portfolio. So again, we have to talk about returns in relation to the risk we're taking on. And one of the things we can see charted out here in comparison to the S&P 500, Realty Income return per unit of market risk is in the 91st percentile of all S&P 500 companies, meaning they've had very good returns and the risk is lower, especially when you consider the beta. This is a measure of the company's volatility in comparison to the S&P 500, and Realty Income is much less volatile. And in my opinion, this is one of the least talked about but most attractive parts of investing into Realty Income. And the same is true as if we compare Realty Income to S&P 500 REITs. Low volatility, but great returns. Now let's start to talk about the recent earnings report just a little bit more. And there's a lot to take in here, but there's one main thing we want to focus on here, and that's the AFFO per share. We can see the prior 2024 guidance was $4.15 to $4.21, but we can see they actually increased the lower end of that expectation to $4.17 to $4.21, so that's actually pretty good news. Forward-looking guidance is typically one of the main things that I look at when analyzing an earnings report. So again, what's going on with this sell-off? Well, to start off, if we go over to the 29th slide, we can start to see what their client diversification looks like. What are their top 20 clients, and what is their percent of total annualized contractual rent? We can see the top one is going to be Dollar General and the second is going to be Walgreens. Now, I've talked about these companies recently on my channel and you've been keeping up. These are companies that are actually really struggling. In fact, I just recently published an article to Seeking Alpha talking about Walgreens, and in that article, I talk about how Walgreens recently announced they're planning on closing around 1,200 stores, with 500 being in 2025. So some people definitely have concerns with the top tenants of Realty Income right now. And not only are they concerned with their portfolio, they're also concerned with their ability to grow moving forward. So let's address this. One of the things we will see is if we look at S&P and Moody's credit rating progression for Realty Income over the past few decades. Realty Income's credit rating has actually increased significantly. Right now, it's pretty high. And so while we could take the time to analyze each one of their companies, the reality is institutions have a lot of confidence in their portfolio right now, and Realty Income is also backed by their strong balance sheet. So yes, you could spend a lot of time digging into the details, but overall, I'm really not concerned with this. But what about their ability to grow? Again, that's a lot of people's concerns. And this is something that Realty Income is currently addressing. We can see, for the most part, they've typically been a retail REIT. They've started expanding a little bit more into industrial properties, gaming properties, and other properties. And one of the things that we can also see is they announced something very interesting in this recent earnings report, and that's their private capital business. Realty Income says they're evolving Realty Income's platform to diversify and enlarge Realty Income's access to equity capital by entering the private capital business, which is expected to enhance our ability to grow earnings and dividend, expand our addressable market, that's a big one, and reduce our reliance on public equity. Now, what do they mean by reducing our reliance on public equity? Well, you have to understand there are two different ways that REITs can grow. One is going to be taking on new debt, and number two is going to be issuing new shares. So for example, if we come up here and plug in stock ticker O, all this data will load in. And like always, you can download any of my spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet by going over to tickerdata.com. There's a 7-day free trial. But back to what I was pointing out, if we look at Realty Income shares outstanding, we can see over the past few years, they have skyrocketed. Now, what's the reasoning behind this? We can see before that, they were definitely issuing new shares. Why did they issue so many more over the past couple of years? Again, it goes down those two ways to raise capital. They can either take out debt or issue new shares. Over the past couple of years, rates have been very high, so it didn't make sense for them to take on new debt. So instead, they elected to issue more shares. While it does dilute shareholders, this was the best way for them to raise capital in order to continue to grow the business. But the good news of the private capital business, like they said, is this will help them reduce their reliance on public equity. So moving forward, we may actually start to see less shares being issued, which I think is good news for shareholders like myself. So we've touched on some of the good and some of the bad of that recent earnings report, but we still need to address the question, is this sell-off justified? Is Realty Income trading at a good price at $57.51? And to answer that question, let's go ahead and jump over to my REIT valuation spreadsheet. We'll go ahead and come up here and plug in stock ticker O. Again, thanks to ticker data, this data will all load in. Now, the first valuation that we want to pay attention to is going to be our AFFO multiples. And this gives us an intrinsic value for Realty Income based on how the market is valuing companies that are similar in structure. So you can see some somewhat comparable companies for Realty Income, and we're looking at the price to AFFO multiple, the valuation multiple for these companies based on their current trading price and their AFFO multiple. And we can see the average for these companies is sitting at 18.93. Now, Realty Income is currently trading at a price to AFFO of 13.44, drastically lower than the average of these comparable companies, indicating that they're undervalued. If we applied the same average price to AFFO for Realty Income, we'd come to an intrinsic value of $81.01 per share, quite a bit higher than that current trading price for the company. Now, the next valuation we'll look at is going to be our historical price to FFO valuation model. All we're doing is we're seeing how Realty Income has been valued historically speaking compared to how they are right now. So we're taking things like the historical price per share over the past decade and the historical FFO per share, and this gives us the historical price to FFO. So if we look at this charted out, we can see on average over the last 10 years, their price to FFO has been about 17.49. But look at it right now, it's sitting at 14.45. So not only compared to these other companies are they undervalued, but compared to how the company has historically traded, the company is undervalued. But let's go ahead and wrap it up and look at one more valuation. One of my favorites, the dividend discount model, and this values the company based on how much they're paying out in dividends and how much that dividend increases over time. If we look at these historical dividend growth rates for Realty Income, typically it's going to average around 3 to 3.5%. So moving forward, I'm projecting a dividend growth rate of 3.25% and a discount rate of 8.5%. And based on those variables, we come to an intrinsic value of about $62.15 per share, about 8% higher than that current trading price. So if we jump over to the output tab, we'll go ahead and zoom out just a little bit, and we can see two of the valuations that we used right here, averaged together, come out to about $71.58 per share. Keep in mind the price to FFO valuation isn't here since it doesn't technically give us an intrinsic value, but we did find that the company was undervalued. So based on all three valuations, Realty Income does look undervalued. Interest rates are projected to continue to go down, and like we've seen, Realty Income is taking new initiatives to continue to expand their portfolio in an economic way. So in my opinion, this sell-off over the past month is completely unjustified. I think Realty Income is absolutely undervalued at these prices. You're getting a very safe and stable dividend yield sitting at 5.61%, that will continue to grow over time and will become even more attractive as interest rates go lower. The company is slowly but surely continuing to grow their AFFO per share, and yes, there have been some problems with tenants, but in reality, I think things are overblown and the institutions seem to agree with me. So no, I'm not panicked at all about this recent sell-off. I'm perfectly happy continuing to hold my shares. But go ahead and let me know what you think of Realty Income in the comments down below if you plan on buying or selling, and like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.